Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Shane Galway of Guinness Ventures to talk about the Guinness VCT. Hello Shane, welcome back to the studio.
Thank you, Jonathan.
First up, for clients that may not be familiar with Guinness, could you give us some background and a bit of background on your own experience?
Certainly. At Guinness, we've been investing for 20 years. I set up the Guinness Ventures side in 2010, and we've been investing in venture capital since then. And our key funds are the Guinness VCT, Guinness EIS, AIM EIS, and our Guinness Sustainable Estate Planning Service.
So we're here today to talk about the VCT. What does that aim to do for investors?
One of the things we launched the Guinness VCT to do is give investors a little bit more choice in the VCT market. It's quite a concentrated market with a small number of managers. We have been investing in venture capital in exciting growth companies since 2010 through our Guinness EIS. And enabling investors to access these through a VCT was something that we wanted to do.
And I guess the EIS fund is one of the largest offers in the market, and this is, I guess, a natural extension of the EIS fund.
Yeah, in many ways. We have a similar strategy. We're focusing on scale-up businesses, so businesses that have already proved up their product, service, or technology and are looking to roll that out to a broader market. So we filter for businesses that have turnover of at least $1 million.
And typically, is the VCT co-investing with the EIS, or is it investing later?
Yeah, so the 5 investments we've made this year are all co-investments with our EIS. So it's at a similar stage, this Series A investing.
Okay. And what types of companies is the VCT looking to invest into?
So we're looking to we focus on scale-up companies. So these are relatively mature businesses that have already established their product market fit. We're generalist investors, so we're investing across a range of sectors, and we're looking to develop a diversified portfolio.
And what do you look for in a management team?
Management is one of the most important things that we due diligence when investing in a business. I think first and foremost, say, have they got a credible business plan, and have they got a credible plan to deliver on that business plan? The other thing we look at is, do they have the skill set to take this business forward? And are they self-aware? Do they know where their limitations are? Do they know where they're going to need help? These are really important elements when looking at a management team. Probably the most important thing of all is do we have an honest and open relationship with them? Without that, I think we can't go forward and invest.
So you launched the VCT last year. You've allotted shares and you've already made your first few investments. Could you give us some examples of investments you've made so far?
Absolutely. So one of the investments we've made is Fable Data. Fable Data use anonymized banking data to provide insights into consumer behavior to their clients. Another business is a business called Baby Mori, and they make and sell sustainable organic baby clothes. Another business is Plotbox, which provides software management systems to cemeteries, both in the UK, Ireland, North America, and around the globe, and are a market leader in that rather unusual niche. Another is Dragonfly AI, that use artificial intelligence to optimize adverts, websites, product packaging for consumer products. So their clients include Coca-Cola, Unilever, Green King, amongst others.
So this is the business that measures the user's attention. Is that correct? Or how appealing a visual advert is?
Absolutely. And so they have a whole data set that was developed with Queen Mary University that tracks eye movement of consumers and how to optimize an image to best stick in the memory of consumers.
Very interesting. And besides funding, what do you do to help these companies succeed?
So we usually take a board seat or an observer role with an investee company, and we look to help them deliver on their strategy in a number of ways. Whether assistance comes through their sales and marketing, finance, introducing new investors, providing workshops. I think one of the things, we're not experts in all these specific areas for all companies, but we have a really experienced team and we have a fantastic network that we draw on to help investee companies deliver on their business plans. And it is a journey we go on together.
And changing topics slightly, the current economic environment, it feels pretty tough. Ventures had a tough 18 months or so. We have higher interest rates, higher inflation. Is that affecting the way you invest? Does it change the types of companies that you back at all?
Just one point on the way we invest. One of the things we're doing, and this is directly driven by higher interest rates, is having monthly allotments. Because once money is in the VCT, it's in a tax-free wrapper and we put it into high interest earning money market funds while we are sourcing investments. The other thing we do within the VCT is we look to make investments in a timely manner. So to draw down that money and put it into growth companies without delay. So that's in respect to actually what we do. In terms of the market, it's actually really exciting. There's so many great opportunities out there. Perhaps, you say ventures had a tough 18 months, but I think what we've seen is through 2022, some strong companies didn't want to come to market because they felt valuations had fallen. I think what we're seeing today is those companies have grown into those valuations. And that makes for some really exciting opportunities. So I think there's a lot to invest in.
So when you look at the operating performance of the companies you back, what you're saying is actually at an operating level, these companies are still growing quite strongly. It's just sentiment that's changed.
I think good companies are performing well. I think the difficulty is particularly with companies that are ill-disciplined with cash. It's an unforgiving market. And I think that's perhaps where the sentiment has changed. I think disciplined companies that manage their business well and manage cash well are rewarded.
So where are you seeing the most attractive opportunities at present? Is there a particular sector that stands out? Or?
There's certain sectors that we have a particular focus or expertise in. Healthcare businesses, some direct-to-consumer businesses, education and ed tech, a range of software and software as a service businesses. These are areas that where we see most of our opportunities.
Changing topic slightly, we've spoken about opportunities. Challenges, what are the biggest challenges you're facing right now?
There's lots of challenges in what we do. I think one area where we have to be particularly careful, and this is true of investors in anything, is not to chase losses. So it's having a robust process for making follow-on investments and ensuring that's the right thing to do. And I think that's a really strong trait in our process, that we scrutinize businesses almost as if we're seeing them for the first time, in order to ensure that we're making the right decision for our investors.
And it's risky investing at such an early stage. How would you quantify the risks for investors at home? How risky is investing in a VCT and, by extension, your investee companies?
Well, probably best illustrated with the fact that small growth companies, they won't all succeed. So in a portfolio of 10 investments, 2 or 3 might not succeed. So that is just something to be aware of. I think what we've seen, investing slightly later stage can reduce that. And in the 50 growth companies we've invested in over the past 6 years, we've had 5 failures. So that's 1 in 10. But that may be a function of the fact that we go in at a slightly later stage.
Okay. So on that point of going in at a later stage, when we look to exits, so obviously with a VCT, you want to eventually start generating dividends for investors. When can investors reasonably expect to start seeing exits within the portfolio and therefore some dividends maybe down the line?
Well, we've seen in the investments we've made, we've seen exits as early as within 12 months, and some of them have taken longer. I think one of the areas we've been particularly successful at is exiting businesses. And most recently, a couple of months ago, we exited Imogen, which was bought by Thomson Reuters. We've also exited Content Cow, which was bought by Adobe, Pasta Evangelist, which was bought by Barilla, the world's biggest pasta maker, and Jones Foods, which was bought by Ocado. So these are some of the businesses where we've generated exits.
I guess it's worth just reminding investors, when looking at your dividend targets, what are you targeting, and when are you looking to start generating that dividend?
So we're targeting a 5% dividend, a 5% of net asset value, and looking to pay our first dividend in 2026.
Fantastic. And so finally, Shane, to sum up, for investors that wish to invest in a VCT this year, why should they invest in the Guinness VCT?
Well, I think first of all at Guinness we have a really experienced and passionate team who have a strong track record of investing in some of the fastest growing, most exciting UK businesses. And I think investors can look to our track record of investing with Guinness EIS and look at some of the great companies we've backed and look to access that through the Guinness VCT.
Fantastic. Well, Shane, great place to end. Shane Gallwey, Guinness Ventures, thank you very much.
Thank you, Jonathan.
If you are watching on YouTube, please press like and subscribe to the channel for more.